Hello and welcome to this managerial accounting video about outsourcing, also known as a make or buy decision. Here's our information, which is on your handout. The Badlands company manufactures 1,000 units of a part that could be purchased from an outside supplier for $15 each. Badlands costs to manufacture each part are shown there. All fixed overhead is unavoidable and allocated based on direct labor. The facilities that are used to manufacture the parts have no alternative uses. Okay, so we're required to decide should Badlands continue to manufacture the part. And then in part B, we'll decide would your answer change if Badlands could lease the manufacturing facilities to another company for $6,000 per year. All right, this is a situation where we have to decide which costs are relevant. So we're only going to look at relevant or avoidable costs. In other words, if we did not make this product, which costs will go away? All right. So let's start with direct materials. If we don't make the product, direct materials will not exist. So we're going to call that a relevant cost. Same with direct labor. These are avoidable costs. Okay. Remember, you think if this manufacturing went away, would we still have the cost? And anytime you have a variable cost, in this case, it's not going to be there anymore, because remember, variable cost would be zero at zero level of activity. All right, so our relevant costs for variable manufacturing overhead. And then finally, they tell us that fixed overhead is unavoidable. So an unavoidable cost is not relevant. That's because the cost is going to be there no matter what decision we make. Okay, so we're not going to take a look at the fixed manufacturing overhead. All right, so what we want to find now is, for part A, our relevant costs to make the product. All right, and we mentioned that our relevant costs consist of direct materials, and the direct materials are $3 a unit. We have direct labor, and the direct labor is $5 a unit. And then our variable overhead, which is $4 a unit. Okay, so our total cost is the three of those added together, which is $12 a unit. Our cost to buy, on the other hand, is $15 a unit. Okay? So the answer to the question, should Badlands continue to manufacture the part? Yes, Badlands should continue to manufacture the part since it costs less than buying it. Okay, and if it asked you for the difference in income, we would say the advantage of manufacturing the part is, it turns out to be $3, right? The advantage, let's put it up here, advantage of making is $3. Okay, so the advantage of manufacturing the part is $3 times 1,000 units per year, and that gives us $3,000 per year. Okay, so now in part B, we want to look at the savings that we're having, so that $3,000, and then we're going to take into account what happens if we can lease this facility to the other company. All right. Okay, so first look at the relevant costs to make the product. Okay. We're going to have our units here and our cost per unit. Okay. So our cost per unit is 12. We have 1,000 units. And so that gives us 12,000 total relevant costs to make. We're going to add to that the opportunity cost. Remember, opportunity cost is what you give up in one situation over another situation. So the opportunity cost of making the product is that we can't lease the facility. So the opportunity cost here is $6,000. All right. So we're going to make our total cost to make $18,000. Okay. All right, so that's the first main number that we're looking at. The second number we're going to look at is the cost to buy the product. The cost to buy the product is $15,000 a year. That's the 15 times 1,000 units. Okay, so that gives us $15,000 a year. So the advantage of buying is going to be the difference between the $18,000 and the $15,000, or $3,000. All right, so let's answer the question. In this case, Badlands should buy the part from the outside supplier and lease the facilities. Okay, we always want to remember to answer the question, and that's what the answer to the question will be. Would our answer change? Yes, in this case they should buy the part from the outside supplier and lease the facilities, and we could add, let's add saving $3,000 per year. Okay? All right, that's the end of this managerial accounting video. I hope you find it helpful in your studies.